In this demonstration, we're going to construct an amortization table for a notes payable. We're going to be using an example from the textbook. However, we're going to make it a little bit more realistic by turning the terms of the loan into monthly payments. So in this demonstration, our company is going to borrow $666,633 in cash. They're going to sign a 3-year promissory note. The note has a 12% annual interest rate, and the installment payments are going to be paid monthly. So each month, the payment we make is going to contain principal and interest. So the first thing we need to do is to determine the amount of the monthly payment. And we're going to set up an Excel spreadsheet to do that. Over in the portal, I have a file called Loan Amortization Template. Either download that or just take a second now to prepare this template. Okay, so your template should look like this right now. And we're going to begin by determining the payment amount. We begin by putting in the amount of the note, and in our example, it's $666,633. We're going to be making monthly payments, which means there are 12 payments per year. The annual interest rate is 12%. Now, in order to construct this table, we have to determine the periodic interest rate. And the periodic interest rate is the annual interest divided by the number of payments per year. In this case, 12% divided by 12. So our periodic interest rate is 1%. Now, our loan is going to be for a 3-year period. So to determine the number of payments, we take the number of years multiplied by the number of payments per year. And since we're making monthly payments for 3 years, we're going to be making a total of 36 payments. We can now calculate the payment amount. We're going to go to our Excel formulas and find financial, and we're going to look for the PMT function. The first thing we need to do is put in the rate, and we want to put in the periodic rate, not the annual rate. So we're going to reference cell C4, which gives us our periodic rate. Next, we're going to reference cell C5, which is the number of payments. And then finally, our loan amount of $666,633 is our present value. The future value is unknown, so we're going to leave that blank. For the type, this loan requires payments at the end of the period, so it's an ordinary annuity. If we had required a payment on day 1, we would place a 1 in the type, and that would be a annuity due. But here we're going to leave it blank, and our payment is going to be for $22,141.75. So let's start constructing our table. We're going to begin our table at time 0. That's the date we take out the loan. We're going to need to have 36 payments, so we can use in a little Excel shortcut. We'll put in payments 1 and 2, and then we'll highlight our 3 payment amounts and just grab that little box on the lower right hand corner of our highlighted cells and drag it down until that little box up there shows 36, and we have quickly set up 36 payments. Our opening balance is going to equal the amount of cash that we borrowed, so we're going to reference cell C1 for the amount of the loan. Our first payment and each subsequent payment is going to be equal to $22,141.75. Excel returns this payment amount as a negative amount to show that it's an outflow. Well, I don't like to work with negative amounts, so I'm going to turn that into a positive amount by simply saying, give me minus cell C6. Now, since each payment is going to reflect cell C6, I can lock that cell in by hitting the F4 key. When I do that, you'll see that there's a dollar sign before the C and a dollar sign before the 6. So that locks in that particular cell, cell C6. I'll now hit enter. That shows a positive amount for our payment, and we can simply copy and paste that down to payment number 36. Now we can move over to the next column in our amortization table, and we need to determine the interest for the first payment. And the interest for the first payment is going to be based on the balance prior to the payment, and that is $666,633. We're going to multiply that by our periodic interest rate. Now we're going to be doing this for each payment. So right now we want to lock in cell C4. So again, we'll hit the F4 key, and our formula says take the balance from the row above and multiply it by cell C4. When we do that, that shows our interest payment is $6,666.33. The difference between the payment amount and the interest is our reduction of principal. So for our first payment, our interest is $6,666. Our principal reduction is the difference of $15,475, a little bit of change. So our new balance will be our previous balance minus the principal. Now we've set up our future payments. For our interest, we have locked the formula so that it takes the balance from the row above and multiplies it by the periodic interest rate. The principal is the payment less the interest, and the balance is the prior balance minus the principal repayment. So right now, we can simply copy and paste, and when we go down to the last payment, we see after the last payment our balance is 0, and we know that we have correctly entered our data, and we have a completed loan amortization table. Well, how are we going to use this in accounting? Well, our amount for each payment is going to be our credit to our cash account. Our interest is going to be a debit to interest expense, and our principal repayment is a reduction of our liability account, notes payable, so that's going to be a debit to notes payable. And we can use our amortization table to construct the journal entry for each of our 36 payments. At the end of any period, in this case, in the end of the first year, after payment number 12, we have the January, February, March, April, May, etc. This will be our December payment, number 12. After that payment, the balance in our notes payable will be $470,365.88.